Most people assume building wealth requires a massive upfront fortune, a winning lottery ticket, or taking a massive gamble on crypto. The math actually tells a different story. A consistent, boring contribution of 5,000 rupees a month can build a 50 lakh corpus in 20 years. That 5,000 rupee figure might sound like a heavy lift at first glance, but if you break it down, it comes out to exactly 167 rupees a day. That is the exact cost of 2 premium coffees or a single casual lunch ordered off Swiggy. To understand exactly how that small daily habit behaves over time, we are going to run a mathematical experiment. We will track that exact 5,000 rupee monthly amount as it is injected into 3 completely different financial timelines over the next 2 decades. We will look at whether the barrier to building a fortune is a lack of capital or simply a matter of how that daily 167 rupees is allocated. Let's start with the default path. In Timeline 1, you play it completely safe and deposit your 5,000 rupees into a standard savings account yielding a 4% annual return. After 20 years, your final balance sits at roughly 18.3 lakh rupees. On paper, the number went up. But out in the real world, an invisible, continuous drain called inflation is eroding the actual purchasing power of every rupee you own. Because average historical inflation regularly hovers around or above that 4% mark, the growth rate in this timeline struggles to keep up. The numerical value of your account is slowly expanding, but the actual goods and services you can buy with that money are shrinking. This means the traditional savings account acts as a financial trap. It secures your money against a sudden numerical loss, but it mathematically guarantees long-term stagnation in purchasing power. Now, let's reset the 20-year clock. In Timeline 2, we route the exact same 5,000 rupees every month into a Nifty 50 index fund, targeting an average historical return of 12%. Instead of trying to pick individual winning companies, an index fund simply purchases an automated fractional slice of the top 50 companies in the national economy. By tying your daily coffee money directly to the growth of the broader market, the outcome shifts dramatically. At the end of 20 years, the second timeline yields a final corpus of nearly 50 lakh rupees. Breaking that 50 lakh total down, your actual out-of-pocket contribution was only 12 lakhs. The remaining 37.9 lakhs were generated autonomously by the market. This is compounding. Your investment earns returns, which then earn their own returns, creating a snowball effect. True wealth generation relies on building a mechanism where the market eventually performs the majority of the heavy lifting. We will reset the clock one last time for Timeline 3. We apply the exact same 12% index fund strategy, but this time you decide to wait. You delay investing for 5 years, bringing your active timeline down to 15 years. That 5-year hesitation fractures the final result. Instead of 50 lakhs, your potential collapses entirely, leaving a final total of only 25.2 lakh rupees. This graph shows the disproportionate penalty of time, cutting the investment window by only 25. If you double your monthly contribution from 5,000 to 10,000 rupees, the exponential curve drives your final 20-year total past the 1 crore milestone. Push that contribution to 15,000 rupees a month, and the final 20-year output reaches over 1.5 crores. To execute this practically, you need an automated mechanism. That means setting up a systematic investment plan, or SIP, on a modern digital brokerage platform like Grow, Zerodha, or Paytm Money. Because time is the primary variable in the compounding equation, initiating a SIP today with a micro amount, even as little as 500 rupees, is mathematically superior to waiting months or years until you have a larger amount to deploy. Financial independence is the long-term mathematical result of a single automated decision made today.